and welcome to the latest Retire Well episode with me, Matthew, and as always, I'm joined by Joe. Today we're going to think about tax-efficient investments for high earners. We've had a few questions on recent podcasts, and we've also had a few clients who've got in touch about what they should do as a higher earner, so we thought it would be a very sensible topic to go through. In general, we'll start with the normal advice for anyone, and then we'll build on to how that's then relevant for the higher earner. So I'll let Joe kick off with the usual starting point of how pension contributions can help.
Yeah, absolutely. And before we just jump onto pension contributions, just to reiterate what Matthew said, we always think it makes sense to do the simple things first. Make sure that you're doing them correctly and maximising it. So that might be stuff like using your ISA allowance, using your spouse's ISA allowance, if you are investing, using any capital gains tax allowance and that sort of thing. But yeah, generally, I think pensions are one of the best things for higher earners to maximise, given that A, they're going to get tax relief at a higher rate than basic rate taxpayers, but B, once they start earning over a certain amount, 100,000's a big one, they start to lose out on certain bits, and by contributing more into your pension, you can essentially get those back and get even more than 40% tax in some cases. When it comes to looking at pensions, there's obviously a couple of different ways that you can contribute to a pension. You could look at sort of a personal contribution. That'd be where you essentially either contribute into your workplace pension or a self-invested personal pension. And generally there you're looking at getting basic rate tax immediately within the scheme, and then anything additional you would have to claim via self-assessment. The alternative to that, which we find if is available is much more beneficial to yourself, is looking at a salary sacrifice contribution. That might be if you're an employed individual and you earn over a certain threshold, you can essentially say, look, instead of giving me my full £120,000, I want you to only pay me £100,000 and put that additional 20,000 straight into my pension. And then that obviously saves tax because you've never been paid the income, but the crucial one there is that you can save on national insurance as well. And with recent increases to employer national insurance, they also may look to follow that in and pay that additional amount into your pension.
Yeah, definitely. I think the big thing here is anyone who is earning over £100,000 should have big flashing lights and big warning lights saying to them, okay, you're in a tax trap where, as Joe says, you start to lose your personal allowance. So by doing that, you're effectively paying a rate of 60% tax on that income. So that sounds like a lot of tax to pay, and you say, okay, how can I avoid paying that tax? The most efficient way is, if you can, adjust your income with a pension contribution to be below that £100,000 point. You've then had more money saved into a pension and you've not been caught in the trap. So that is the one that when I have a conversation with someone who's in that tax trap, it's amazing how many people don't quite realise the options, and they've just gone, I've worked more, I've earned more, and that's fine, and the tax is what it is. Well, actually, at that point, the tax is a bit aggressive, and that's the point where good planning can really kick in.
So just to reiterate what that trap is, essentially, when you start earning, you've got your $12,570 as your personal allowance where you don't pay tax. Between then and essentially $50,270, that's your basic rate tax band of 20%. And then after that, you start moving into the higher rates of tax at 40%. And most people think, oh, well, I don't start paying 45% tax until much later. But the fact that you start to lose some of your personal allowance once you earn over £100,000 brings in that 60% tax rate. So the way that it works, for every £2 taxable income you earn over £100,000, you will lose £1 worth of your personal allowance, which means when you essentially get to £125,140 of taxable income, you've lost your full personal allowance. And the way that works, instead of it being taxed at zero, it essentially jumps straight into that 40% tax bracket of that more income tax that you will have to pay.
Yeah, definitely. So it's a no-brainer that if someone is in that trap and they can afford to give up some of the income, that they should. Again, Joe touched on salary sacrifice there. If someone's got that through work, the easiest thing to do is just to say, how much of my salary am I willing to sacrifice? And by pulling that down below that £100,000 figure, they're then able to be more tax efficient. Again, there's an argument to say, should they also sacrifice more and put more into a pension? And for us, that all comes down to the opportunity cost to say, what income do you need to match your expenditure, what are you saving, and can you afford to put more into a pension? And that very much comes down to age profile, attitude to risk, what you're saving towards. Again, I've had lots of clients in that situation who say, I would love to put more in, but actually I've got a young family and I've got a mortgage, and actually I do also need the money to come through. So I think that's the balance that's important, not to just let the tax tail and the efficiency wag the investment dog, or the decision dog in this case.
Yeah, I mean, another thing that you've mentioned there with regards to family, I've spoken to clients in the past where they've essentially said, look, I'm happy with what I'm already putting into pension contributions. What else can I do? And that's where you can actually start to have a conversation with your employer of going, look, instead of giving me a pay rise to go up there, let me drop down a full week off would be nice. 1 day per week, which will give you a little bit more flexibility for the family and that side of things. And just staying with that as well, making contributions doesn't just make sense over 100,000 to gain it back. Also between 60 and 80,000, you lose in your child benefit. Again, if you're round about that threshold, it can be worth it to sit down and look at how much you're missing out on. Can you maximise your pension contributions while getting some of your child benefit back there?
Definitely, and I think all of these things, the real message we've got is to understand the implications and make an active decision. The person who goes passively through in these traps can get caught and not really understand it. So, child benefit, definitely, if you're caught by that and you've got income in that range, certainly worth a conversation. If you're a higher earner earning over £100,000, again, certainly worth a sit down with a financial advisor just to understand where you are and what you can do to adjust it.
Yeah, absolutely. And I suppose, again, we'll touch again on how much you can pay into a pension, because you might be sort of well over that £100,000 mark if you have sort of bonuses, and even if you've got a higher base pay, and you think, well, actually, even if I put the full 60,000 into my pension this year, I'm still not going to get my full personal allowance back. And that's when you can start looking at what's called carry forward allowance. So the way that works, essentially, you've got the 60,000 in the current tax year, but if you have any unused allowance from the previous 3 tax years, you can also start to look at them. You have to use the allowance from the current tax year first, and then it goes to the sort of the earliest tax year that you haven't used moving forward. So the annual allowance has changed. It changed in sort of 23, 24. So if you were to contribute in the current tax year, if you haven't used any, you could potentially contribute up to 220,000 in the current tax year, and that's 40,000 from 22, 23, and then 60,000 from the other tax years.
Yeah, and this is quite a sort of a technical area, and you might already be put off by some of the numbers that we're looking at. But the simplest way of doing it is to say, someone can save up to £60,000 in the current tax year, or 100% of their, relevant earnings, whichever is lower. So again, if someone has got £130,000 worth of income, that's when they're saying, okay, 60,000 is what I can put in this year, as Joe described. And because they've got that headroom, they can also look back previously at the unused allowances that Joe describes. Another example of this would be, a business owner potentially making contributions from the company, where they could be making that as a company contribution rather than a personal contribution. We've touched on that in previous episodes, but again, it's just basically understanding for each individual circumstances, what can you do to be efficient, and also what works in your remit. We've had people who say, okay, I'm going to have 1 year where I've got big bonus, so that might be the year when I'm looking to put a large contribution in and looking to go back through that unused allowance. And that's sort of the conversations that we often have with people. Yeah,
and I think another sort of case study that I spoke to a client a couple of weeks ago, where he's in a similar situation where he's got a good amount of carry forward allowance available, but he only earned just over £100,000. So if he used that full carry forward allowance in one tax year, he would only be able to claim higher rate tax on a certain proportion of it, because if he used it all, it would bring his earnings below that 50,270, and therefore he wouldn't be able to claim the full amount. So we looked at him about how can we sort of tactically split that across 2 tax years to really maximise the tax relief. And again, it goes in hand with what Matthew said about if you do have a bonus, or there's a bonus coming up every 3 years, or some form of award, then you could almost save your carry forward for those years and put it in then.
Yeah, definitely. And again, we are getting quite into the detail, But there is a bit of another trap where if someone has really, really high earnings, they can start to lose some of their annual allowance with the tapered annual allowance. Do you want to touch on that just as a bit of a warning if someone sat there with very high earnings thinking this is a no-brainer, I'm going to put 200 grand into a pension?
Yeah, it's very similar to the sort of the personal allowance tax trap in sort of the 100,000 to 125,000. If you start going over adjusted net income of 260,000, which for all intents and purposes you can essentially look at it as total income minus pension contributions, then you can actually start to lose some of your annual allowance. So instead of being entitled to the full 60,000, you might only be entitled to 40,000, and that tapers right the way down when your adjusted net income gets over 360,000, where you've essentially only got 10,000 that you can contribute into a pension each year. And that's where obviously it can get much more complex with regards to financial planning, and we've got to look at some alternatives, which we will discuss in a second. But I think if you are in that sort of position, it's definitely worth speaking to an advisor, looking at sort of how else can we look at planning for the future.
Yeah, definitely. I think, again, we jumped into pensions, we've jumped into the technical bits, and really it's just highlighting the bands where people should be having the red flag to say, there's a planning opportunity, what should I do? Someone who's got 250,000 or 300,000 pounds worth of income, they've got a few red flags that they should be looking at, talking to someone for structure. Someone who's got 100,000 pounds, again, should really be saying, I should be doing something with my pensions as a minimum, and I should really get advice. Other areas, when it comes to earnings and salary sacrifice, is that element of what does your employer offer so you can adjust your income down and you've benefited from it. So it might be things like private healthcare or cycle to work schemes or things like that. Each employer is different. Smaller employers might not offer as much, but certainly large employers, there's various options. So it's worth higher earners thinking about how can I reduce my remuneration and have potentially other benefits.
Yeah, it might be the case that you do those things anyway outside of work, but if you are in that sort of 100 to 125,000 trap, anything that you salary sacrifice in, it's essentially like a 60% discount on what it is. So definitely worth looking at, as Matthew says.
So I think that covers what we would suggest for pensions with higher earners. So if we move on to think about some of the investment products that we would also talk about when investing capital, we'll think one about a product that's going to give us some income tax efficiently over the long term, and then we'll also look at a few products where there's an immediate tax saving. So one of the most common things that we're talking to our clients about at the minute is investment bonds. That's a product that, there isn't any CGT within the bond, and because of what the recent government have done in terms of reducing CGT allowance and increasing the taxation rates, that's created almost more reasons to use an investment bond, and certainly becomes a really good tool that a higher earner's got for investing.
Yeah, absolutely. As Matthew said, that capital gains tax allowance, particularly when you're a higher earner and you're in the higher rate tax bracket, A, you've got less allowance available, but B, most recent rules have actually increased the amount that you would pay on that. With regards to investment bonds, the way that they're structured is that there's absolutely zero capital gains tax to pay within there, and essentially what is set up as is that you have a tax deferred allowance, where if you were to invest £100,000, you can take out 5,000, so 5% of that initial investment each year, and that's tax deferred. There's no tax to pay on it, and then you can do that for a period of 20 years, which equals 100% of the original investment before there might be a tax to pay. So if you think about when people are high earners and when they'll reach their peak, it might be sort of in the mid-40s, which means if you wanted to take out income from that over the course of 20 years, you'd get all the way till sort of 65 if you've started invested in your mid-40s. And I think one of the big benefits of this, as Matthew alluded to at the start, is you can essentially defer the tax that's payable while you are a high earner, and while anything that you pay taxable on it would be at a higher rate, to potentially moving into retirement when you might just be a basic rate taxpayer, a no rate taxpayer or otherwise, where you can actually draw it out at a lower rate than what you would in sort of a more common investment like a general investment account as you would now.
Yeah, I think what we're doing with an investment bond is almost providing the ability to take income as return of capital, so without that immediate tax consequence, But if you don't take it straight away, you could then say, oh, well, I've almost let 5 years of that 5% roll up. And if that corresponds with something like retirement or change in jobs or something like that, I can actually supplement an income without taking taxable income. When we were talking about the pension before, again, you might have to wait till minimum pension age to access that. With the investment bond, you don't have to do that. So it could be a tool for people accessing funds earlier, or equally it could just be that I've got excess capital and I want to save it for the long term, and it then comes into the planning of another tap to take in the future.
Yeah, I think it can work really well in conjunction with a pension as well, because if you're wanting to make £50,000 a year income from a pension, and you might have a state pension there as well, if you're drawing money out as taxable income, any more would essentially be taxed at a higher rate. So by having an investment bond there on the side, you can almost see that as an additional amount of tax-free or tax-deferred income that can sort of help supplement you in retirement.
People, when we talk about the onshore and offshore version of investment bond, often get a little bit spooked by the offshore version. There's nothing untoward about it. Do you want to sort of touch on the tax consequences and why we look at both?
Yeah, absolutely. I mean, whenever I speak about offshore bonds, it's similar to what Matthew says. They might think that it's an investment in, I don't know, Tuvalu or something like that you'll never be able to get access to. But essentially the offshore bonds that we use and most financial advisors in the UK use, they'll be sort of domiciled in Dublin or the Isle of Man, so still close to home. And the main benefits of them compared to an onshore bond is that there's no sort of life tax essentially to pay within the bond. So within an onshore bond, the life tax is 20% within that bond, which means if you are a basic rate taxpayer, you're never going to get that 20% back. Whereas in an offshore bond, it's completely tax-free. And that only really sort of comes into it when you're looking at sort of drawing out from the bond above that tax-deferred allowance of 5%. So if you were to, and it's called a chargeable gain if you do that, if you were to make a chargeable gain on the bond, on an onshore bond, if you're a high rate taxpayer, they essentially assume that you've already paid that 20% within the fund, and you would be taxed at sort of a 20% tax rate on the way out. Within an offshore bond, there's no tax to pay within the fund. So if you're a high rate taxpayer, when you pull it out, it would be taxed at 40%. And you might think, well, that's a bit strange. Why do we want to be paying the full tax at 40% as opposed to 20% tax when you pull it out? I suppose that's when it comes to, at the moment, you're a high earner, and you would be if you pulled it out now. Yeah. But if you're looking at sort of 10 years time, 20 years time, when that sort of chargeable gain may be due, you may actually be a nil taxpayer. You might not be paying any tax, or you might be a basic rate taxpayer. So I think that's one of the big benefits of an offshore bond as opposed to an onshore bond.
Yeah, definitely. One of the other things I like about an investment bond is the way it's made up of lots of segments. So for ease of thinking, you could imagine the investment being made of 100 segments, but in reality that could be 10,000. And what's really good about that is you could choose to assign it in the future. So again, we might have that high earner who's put £100,000 or £200,000 into an offshore bond. They then come 15 years down the line and say, actually, I don't need to take the income here, but I have got a son or grandchildren who I'd like to gift the money to, and then logistically you can assign a number of segments, and crucially in what Joe's described there, you can use their tax allowances to look at the gains. So you could say, of the 100 segments, I've given 10 to this grandchild, 10 to that grandchild, and they've then chosen to surrender it and cash it in their name, and they've seen the gain, which could be that they're not working at that point. So as Joe describes, when you look at that income that's been, you've put money in when someone was a high earner, and then in the grandchild example, if they're a nil earner, that gain's been fully adopted essentially. So I think that's a really crucial point as well when, as well as tax rates being squeezed, we're seeing inheritance tax being talked a lot more, and the idea of being efficient on both points is very important.
Yeah, absolutely. I mean, not sort of stay on investment bonds for too long, because there are a lot more advantages from sort of an inheritance tax point of view when you're looking at it from a trust example.
Yeah.
We'll probably look at that in sort of a future episode to cover it off. But I think they do allow that flexibility there to potentially assign it in the future.
Yeah, definitely. So I think if we move on to think about more of the immediate tax savings, we did have a comment in a previous video to say if someone's won the lottery, and we were talking about investing, we talked about ISA allowances, we talked about pension contributions, someone commented to say, oh, well, why aren't you doing X, Y, Z? So I think we're going to now touch on some of those slightly more complicated investments which have got the tax relief. I think the big caveat with this section is it's all about additional risk which comes with the tax saving. So therefore, anyone who's thinking about these investments has to really think about their own attitude to risk, and you have to be very comfortable to go into what might be illiquid or high risk. So for a lot of our clients who are approaching retirement, they don't want to think about these investments because they're too high risk. But we have some, business owners and high earners who say, okay, the tax saving outweighs the risk, so that's why they're willing to look at it.
Yeah, I think it's worth, before we actually start on these as well, is look at sort of why are those income tax reliefs and in some cases capital gains tax and business reliefs, why are they in place? And I think that the main reason for these investments, all of them that we're about to talk about, focuses on investments in small companies in the UK, and it's essentially a push by the government to give capital to those companies that might not otherwise be able to fundraise and grow as a company and grow the UK economy, but they are inherently risky, because if it's a small startup, there's a high likelihood that it could fail. So the sort of income tax or sometimes capital gains tax reliefs that you get with them essentially are, we're rewarding you for investing in the UK. We're aware that you might lose some of your money on it. Therefore, we're going to give you an income tax relief on the side.
Definitely. So the first product that we're going to look at here is a VCT. So that's a venture capital trust. The main benefit here is that someone can get, 30% back of anything they put into a VCT off their tax bill, and that's up to a maximum figure of £200,000 per annum going in. So in theory, there's £60,000 worth of relief there that could be achieved. As Joe describes, you're investing in startup companies and small companies here, so you're saying you're willing to tolerate the chances of them. You might look at a basket of those companies, and you're saying that some of those might go bust, but you're hoping that you're going to get, you're not going to have more than a 30% loss on those companies to offset the tax, I suppose.
Yeah, the VCT essentially is a listed company that buys other smaller companies. As Matthew said, the tax relief is quite generous at 30%.
Yeah.
But with this and the other products that we'll look at in a second, you can only get relief on something that has been taxed.
Yeah.
So if you've only been taxed 20,000 and you were to essentially put in the investment that would need for 30,000 or 60,000, you would only be able to claim the sort of 20,000 as tax relief. I suppose one of the big drawbacks with something like a VCT is that you need to hold the shares for at least 5 years.
Yeah.
If you hold it for anything less, then you have to pay back the relief that was payable. With VCTs, as Matthew said, they are inherently risky. And I was looking through sort of at the different VCTs that offer using a research provider that we use for them, and just looking at sort of what the 5-year performance might be. And it varied from essentially 100% return over 5 years, so doubling your money, and I wish I was in that one, compared to losing 77% of your investment, which is clearly above and beyond what relief you would have got in the first instance.
Yeah, and I think, a VCT, there's no capital gains tax, and there's no, dividends, there's no taxation on the dividends that they produce. So someone could say, okay, with an investment in the VCT, I get the initial 30% tax saving, and then I have to hold it for 5 years, but they are paying dividends potentially, and that is tax-free. So someone might say, okay, that's a brilliant addition to a pension. For me, I think it's definitely got a place for that high earner and for the individual who's high risk, but it's the diversification piece. It's the small pot of your overall plan. The big risk is it's in illiquid, small, companies, and you might see large fluctuations in the value. And as Joe describes, you need to make sure that you've had good advice to pick an appropriate manager, an appropriate product to get into. Charges in this area tend to be quite expensive as well when we compare them to a traditional investment, and that's because of the additional levels of risk and therefore the research that has to be carried out with those smaller companies.
So yeah, as we've said there, I think VCT is right in some instances, but it's always one where we'd look to, can we reduce our income elsewhere to not actually get that tax bill in the future, for example, by contributing to a pension, and then if there is any remaining income tax that's significant and we want to take away, you can look at that through a VCT or a venture capital trust. Moving on from that, we've got quite a similar product in an EIS or an enterprise investment scheme, but it does have a couple of different nuances compared to the VCT. So an enterprise investment scheme, essentially you invest in privately owned companies in the same way that you would in a VCT, but instead of investing them through a company that holds those companies, you invest directly or through a fund manager. The allowances are slightly different as well. You still get 30% tax relief, but the maximum investment through an EIS is £1 million, which means if you were to invest that 100% of the £1 million, you get 30% tax relief, and you could potentially get £300,000 worth of income tax back from the government. So not that many people will be using that full allowance of $1 million. Most people, to be honest, would be happily serviced by a VCT, but this option is there. The other bit with regards to an EIS as opposed to a VCT is that there's a 3-year minimum hold as opposed to that 5-year minimum hold in a VCT.
Yeah, one of the main reasons why people think about the EIS over the VCT is if they've got a capital gains tax bill that they're going to roll into and essentially defer with the EIS. So again, if someone had an income tax bill and a CGT bill, that's when they're rewarded here for the extra risk and the illiquidity. But again, it has to be something that you're very happy with the risk. So we don't see many clients wanting to invest funds, but certainly it's worthwhile looking at. Again, when it qualifies and it can fall out of your estate for IHT, again, you're almost saying there's a potential third strand that someone could be looking to benefit from.
Yeah, so with the CGT deferral, I suppose it works in a similar way to the investment bond, that if you've got a capital gain tax bill when you're a high earner, you could potentially roll it into an EIS investment, wait until you're a nil taxpayer or basic rate taxpayer, and then essentially realise that CGT gain then at a lesser rate.
Yeah.
Or you could hold these shares until you pass away, and then that capital gain would be wiped out on death.
It's a less cheery approach.
Yeah, less cheery. And then as Matthew said there, these also can qualify for business relief as well, which means if you hold these for 2 years, the shares themselves, not just that capital gain, can essentially be exempt for inheritance tax. And then the final thing to mention on EIS for me is the fact that the government again realised that these are risky products, and if you actually make a loss in these schemes, you can actually offset it against potential future years' income tax liability.
Yeah, definitely. And I think the smaller brother or sister of the EIS is the CDIS, so it's worth touching on that. Again, if someone's looking for advice in this area, it's 100% something you'd want to talk to a financial advisor about. But the main benefit with the CDIS is it's smaller startup companies, so you get a higher relief, you get the 50% income tax relief. But again, you have to be comfortable. I sound like a broken record, but you have to be comfortable with the additional level of risk that you're taking on there.
Yeah, it's very rare that we would ever really recommend a CDIS, except for sort of an ultra high earner, when you consider the amount of tax relief that you can get from both a VCT and an EIS. Most people will be happy with that. The other benefit that you get from a CDIS, you do get the 50% capital gains tax reinvestment relief as well, so could potentially half your capital gain tax bill there.
Yeah, perfect. Anything else you want to cover on those bits, or do you think we're happy with those?
I'm pretty happy. I mean, I think anyone that's looking down this route would be speaking to an advisor anyway, to actually access the investments.
Yeah.
And that's for a reason. It's to make sure that you're fully aware of the risks and you are being advised properly.
Yeah. And a few people recently who've been watching the podcast have suggested that we should have a jargon buster, just almost go over some key topics. And I think it's almost worth just doing that now on some of the terminology we used in relation to the pension contributions. So I think if we think about the annual allowance and carry forward, they would be two good bits of jargon for us to just quickly go over. Do you want to start with the annual allowance?
Yeah, so annual allowance is essentially the amount of money that you can put into a pension in any one tax year. Your annual allowance for the current tax year is 60,000, but you are only able to put 60,000 in if you earn at least 60,000. If you earn less than that in any one tax year, then that's essentially your personal annual allowance.
And the carry forward element is to say if you're looking to put more than that in and you've got income available to do so, you can look back for the previous 3 tax years to use any unused allowances, and you're going back to you're using this year first, and then you're going back to the previous 3 years starting at the earliest year. So hopefully we've tried to simplify that and not overcomplicate it, and that's what we'll continue to do as we add this jargon buster feature. If you have got any specific bits of jargon or terminology that we've used and we've not explained well, please leave a comment and we'll try and touch that on a next episode.
Yeah, fantastic. And then we'll finish off with a listener's question. So we've had this, to be honest, it's been a couple of times in the podcast comments, and also I've heard it from clients myself. It's someone who's essentially already maximised their pension allowance. Is it possible for them to invest on behalf of their spouse if they've already used their allowance? And I suppose that goes for pensions and ISAs.
Yep, so ISA is an easy one where the answer is yes. Again, you've got a £20,000 ISA allowance each, and if you've used yours, you can use your capital to put into a partner or spouse's ISA. That's a very sensible idea. When it comes to the pension, it's slightly more complicated. As we described with having the earnings available to put into the pension, you can't use those earnings to put into someone else's pension, but you could use your capital if they had earning available and they weren't making the pension contributions. So if we had a couple where someone had £40,000 worth of taxable income and someone had 20,000, and you were saying, okay, well, I'm going to put 20,000 into mine, I could also then put £10,000 into my spouse's to try and benefit and equalise that up.
Yeah, I think, it's an interesting one, and we'll speak about it in a couple of episodes' time about how best to equalise those pensions, but it's almost a trade-off between that tax relief at a higher rate, in which case it might make sense to go in yours, although if you've used your allowance, you've used your allowance, and then equalising those pensions. And then on the ISAs, just to finish off, you can invest in your spouse's ISA, that's fine, although it is their money. If you don't have, or if you've used both of them and you've got children, you could then look at sort of junior ISAs and how they may benefit, and that's 9,000 per child that you can invest in them.
Perfect. I think that's great and covers a lot of area. Again, if you've got any questions or any topics you'd like us to follow in the future, please leave a comment below.